Okay, you are in, we did earlier the how session right before lunch, and then there was a why session. This is really deep into some of the how, and so we're going to tell the story of our Friends and Family CD on this session, and since two of us are involved, we'll try not to take too much time with it, but there are other, Amy has a totally new tool that helps you invest locally, and then Brian Becken has the DPOs, and we're going to go more into nuts and bolts detail. One of the things that it seems really clear that there is a need for something like professional education for localizers. Because like Michael Schumann was talking about, this is happening in the Twin Cities. Oh, gee, how does that fit in with what I'm doing? And there's so many things like that. Bernal Bucks and Credibles, all these kinds of things. There seems to be, do the people here think there needs to be a big conference that really explains how to localize your economy? We're trying to see if there's a need for one. I think, there's so much going on. We don't know enough about what's going on in Fresno. There are all these things happening. So we're going deep into, we'll get a little bit wonky. And because Connie and I might take it over, we're not going to start with us because we're so involved in our story. Tell me about Investibule. This is Amy Cortez, LocoVesting. She's got a new tool called Investibule.
Okay, yeah, this one's not working.
There's two that work.
Okay. Hi, everybody. Hello. So Investibule is a new tool, and where it's coming from is that I've been following this evolution of financial democratization, which is a fancy way of saying bringing finance down to earth, to people, right, and sort of reclaiming investing. It shouldn't be this esoteric thing that we're afraid of, or that's, the domain of Wall Street, or it's a black box. It's actually, it can be a very personal thing. And Matt from Etsy was talking this morning about making deep connections, right? Rather than, we don't want to be a broad platform. Like, this is really about connections. So there's been a whole proliferation of new ways to invest locally or to invest in a community you care about that shares your values. These new ways are stemming from law changes like the Jobs Act at the federal level, which now allows anyone to invest in private companies. Before, you pretty much had to be a wealthy investor. There are also laws at the state level. 30 states have kind of their own mini Jobs Acts. And then there are all of these other things, like Brian will talk about DPOs. There are things like Credibles, Kiva, no-interest loans, a whole bunch of ways you can invest locally. But with the crowdfunding part is kind of exploding, right? It's brand new as of May. There are already probably about 15 platforms that have gotten approval. That's not including at the state level. And this is really going to explode. So just a show of hands, like how many people can name an investment crowdfunding platform? Like, call out names. Okay. WeFunder. Okay. So, but there are many, and they've done surveys, and most of America has never even heard of crowdfunding. So Investibule is a platform that aggregates all of these offerings across multiple platforms, across multiple offering types, and brings it all into one easy-to-use place where you can discover investment opportunities in your community. So in other words, you don't have to go out and search Kiva, and then go on to WeFunder, and then go on to Republic, and then look at NextSeed, and then see what DPOs may be happening in your area. So we're just trying to bring that all together in one easy place, not doing transactions. Once you find something that looks interesting, you would click on the link, and then you would go to that site, whether it's WeFunder or Kiva or Credibles, and make your investment. So we're covering, as I said, multiple offering types. And this is the stuff we don't think most people are going to want to deal with. You know, it may be Title III crowdfunding, it might be Regulation A, it could be a revenue sharing loan, it could be a no interest loan, it could be a prepay. But, you know, we're just bringing them all together, and, you know, it's up to the investor to decide. And there should be something for everyone, whether you have $25 to invest or $250 or $2,500. And I am working on this with Arno Hess, who you heard earlier speaking about Credibles, the prepay system. We're in beta. We're happy to show the product to people. And our mission is really to help shift capital to some of these new community capital platforms and investment opportunities, and help accelerate that shift that Michael Schumann was talking about this morning. How do we you know, move money that's sort of stuck in Wall Street and business as usual and put it to work for some of these new opportunities?
What's your customer acquisition strategy? And where do these people hang out, and how do you find them?
Well, it's sort of a spin-off from Locavesting. So for the past year and a half, I've had this website, locavesting.com, and I've grown an audience there of people who come because they're interested in local investing. Either they're an entrepreneur, or we get a lot of investors. So it's a media and educational platform for community capital. So that's one place. They're coming to the site. They can then just from there quickly go to this other site and start browsing.
Looking to buy keywords and other things like that, or?
Yeah, we're still beta though. You're getting a little ahead of us.
Okay, all right, that's great. Oh, interesting. Yeah, and that just points out to the fact that, you know, we're in discovery about this market. I mean, this is in the three-part market evolution thing. This is who's doing what. It's discovery. Then there's cooperation, which is the stuff we're doing with Self-Help and Impact Hub Oakland. And then there are exchange-like things or products. And DPOs kind of fit with it, an exchange-like thing, because you've got a way. Why don't you explain more deeply what DPOs are, where they work, and how do they fit with this new crowdfunding law? This is Brian Becken. He sometimes goes by John Kadovich, but only sometimes.
Right, thank you. So John Kadovich was scheduled to be here, but couldn't, but I'm glad to be here. So direct public offerings, or DPOs, are a way of raising community capital. And by that I mean it's a way for an entrepreneur to go out to their own community, whatever that community may look like, whether it's a geographic community or otherwise, and raise capital from the people that they would consider their ideal investors, the people that want to support them, the people that believe in them, the people that live down the street, or whoever they are. And this is a true public offering, so you don't have to necessarily know your potential investors. You just find some way of reaching them, whether by advertising or putting on your website or whatever it may be. It's a way of doing a true public offering directly, and that means without the use of an intermediary, without the use of a broker-dealer or underwriter. And it actually has been legal for 100 years. It's not a new strategy. People sometimes talk about, Jobs Act ushering in making it possible for the first time for organizations to raise capital from their community. It has actually always been possible. It's just that you got to jump through the right hoops and know what you're doing. So direct public offerings, we think of this as a type of investment crowdfunding. The Title III crowdfunding that we now hear often about is another type of investment crowdfunding. But direct public offerings are, as I said, a way to go directly to your community. You don't have to use a third-party portal. You can put it on your own website. Any entrepreneur can do it, any company, any nonprofit, any industry. It's a very, very useful tool to help democratize capital, and by that I mean opening up a level playing field for anybody to invest on exactly the same terms. So the rich don't get a better deal than the poor. Everybody can invest on equal terms.
And so if I'm looking to use crowdfunding, when would I use one of these portals in a type 3 crowdfunding, and when would I use a DPO, and how would I make that decision?
Yeah, great question. So under the new Title III crowdfunding rules, you can raise up to $1 million, and the nice thing about that is they can be in multiple states. You don't have to comply with state level regulation. So Title III does make sense if you want to raise less than $1 million and have investors across state lines. If you want to raise more than $1 million, you can either do it in one chunk, $1 million increments via Title III, or you can do a direct public offering, which can be done without a limit as long as you're willing to stay within one state, have all your investors in one state. Under what we call the intrastate strategy, you can raise an unlimited amount of money from your community via a DPO. So it kind of depends on how much you want to raise, where your investors are, and what you want to do with it, and so on. So one strategy, there is definitely not a one-size-fits-all. It depends upon your situation.
What's the average size of a DPO that you're seeing in this new phase where you've kind of revitalized it?
Yeah, well, it used to be that the sweet spot or average size was about 300,000 to 500,000. Now that Title III is in place, people are gravitating more toward Title III and going on to some of the crowdfunding portals out there for those smaller raises. So now we're finding that the average DPO size is above $1 million, because that's where it really makes sense to do a DPO instead of a Title III raise.
Can I ask a quick question? Isn't it true, though, that the DPOs are way more expensive than a Title III on the entrepreneur side, legal? The legal setup of a DPO, I understand, is fairly expensive.
It isn't necessarily. We've pioneered some ways of keeping the cost way down, so a DPO can be done for sometimes as little as about $15,000. If you're going to raise $1 million on a Title III portal, you'll end up paying perhaps 5% to the portal operator, to the intermediary. So that could end up costing you $50,000 for $1 million raise. It kind of depends. I mean, that is a factor, and one issue that that people are telling us is that, well, if I go onto a Title III portal, I only my fees depend upon how much is raised in the deal, and that's something that, if you use a DPO, the cost of doing the DPO doesn't depend on how much you raise in the offering. In fact, it can't legally depend on how much you raise in the offering. You have to have a broker-dealer involved to do that. But your legal and compliance costs are going to be somewhat fixed, regardless of how successful the DPO is. So that is a factor, and that's another reason why people might prefer it might be considered a lower risk scenario under Title III. Either way, it takes some work to raise the capital, whether you're using a Title III portal or doing a DPO. It's not the kind of thing where if you build it, they will come. Either strategy requires that you go out and do some work to bring in investment.
It's interesting, though, what we're seeing with Title III deals is the average deal is like maybe 100,000, and you can set a minimum target and a maximum. A lot of people have a minimum target of 25,000. And a maximum of maybe 100,000. So it's been surprisingly low. And I think that speaks to the big gap in the market for small businesses that don't need millions of dollars. They're not on the unicorn track, right? They're just, they need growth capital, and it's often something much lower. But of all these, sort of new exemptions, the least expensive way to raise capital would be an intrastate offering. If you live in one of the 30 states, and you can only raise money from your people who are residents of that state, but that's local investing, and the legal barriers and the costs are usually much lower.
And of all the DPOs and Title IIIs, what's the sort of penetration or funding of marginalized communities? Is it mostly folks with money who are funding folks they know, or how's that working?
From what I have heard so far, and this is something I want to look into, but there is a proximity relationship. So most people that are investing are in the physical proximity to some degree. or they're in a community. Like one of the first very successful offerings was Beta Bionics. It's a medical device, smartphone controlled for type 2 diabetes or type 1 diabetes, I forget, but people in the diabetes community funded that. So we're seeing a lot of that. In terms of diversity, the types of businesses have been diverse, but I would say there's probably, of the 50 or so offerings so far, probably just a handful of people of color, entrepreneurs, and maybe just, double that for women. So, and a lot of it is concentrated in California and New York and Texas for some reason, but, and there are some outliers, but, it's new, and the whole purpose of this is to level the playing field and get capital to all sorts of entrepreneurs that have been underserved, including those in rural areas that, don't have a good funding ecosystem.
And then we're going to go on to the nuts and bolts of, the Friends and Family CD. So it started with you asking me a question. Why don't you just start there?
Well, I was, I don't know, a few SOCAPs ago, maybe 4, 5 SOCAPs ago. It was my first SOCAP, and I came here, and let's just say that this room looks very different than it did there. It was way less diverse. It was very few people of color at the SOCAP, and most of the people, almost most of them, a big majority, were Africans from Africa. And I noted that very few African Americans were there or being even spoken about or in any way about investment. And so I asked Kevin, why, it was a rhetorical question, why is it that there's a comfort in investing in Africans but not in our own which is great, all that needs to happen, but additionally not in our own backyard and not for African Americans. Where's the money for African Americans?
And so I hadn't really seen it till she pointed it out. It just, whatever. And I looked, and there was more entrepreneurs working in Uganda and Kenya than were working with or were African Americans. And many more all over Africa, but those two countries outnumbered that. And it was like, well, look at that. And we scholarship 150 entrepreneurs to SOCAP, and there were this many Africans and this many African Americans. And it was just, it was like, well, how weird is that? It just hadn't occurred to me. I got it pointed out. So I thought I would do something clever, and we had a panel where we talked about it. And so I thought, well, people will get embarrassed, and then they'll do something. And so we did, and then we did, and nothing happened. And so, well, that didn't work. I mean, there's historical precedent for embarrassing the powerful and nothing happening. This has happened before. So I was looking for, well, what can we do about that? Because it was a significant gap in this. I'm proud of SOCAP. There was a gap. And I ran into Jessica Norwood, who's here or was here. She's off meeting with folks lots of the times. And she said, look, this is the leverage point. This is the Danilo Meadows system leverage point there's seed stage, there's angel investing, there's Series A, but Friends and Family is a social thing. You give some money to your nephew or your niece because you've seen them over time, and you're just going to give them a chance, and if they blow it, it's part of their education. It's a friendly capital, but actually it's huge. $90 billion goes out every year in Friends and Family, and 23% of those who get venture backing started with Friends and Family. But then, as Jessica pointed out, that African Americans have on average 11,000 in family assets, and whites have 144. And the national statistics are you need 23,000 to launch, and if mama and your uncle have 11, you're not getting to 23. And so it's a structural gap, and we're trying to kind of institutionalize the lack of a rich uncle. and it's a little bit better with Hispanics. It's about 13,000, but we're starting to talk to folks in San Francisco about bringing it here, and you have to have a lot of things that make folks investable who don't know what an investment is and didn't grow up with their daddy with the portfolio and stuff like that. So we work with Ronnie Kroger, who we've pointed out before, who is helping people learn and become investable, and wrap around services, which is a nonprofit word, or venture-like investing is. And so I guess I'm getting ahead of myself because I live in North Carolina because my grandsons moved there, and Self-Help is there, and they've got some of these creative CDs that they mentioned. There's a mothers and children CD. So I know they've done creative CDs, and I got to know Napoleon Wallace, who's a real amazing genius there, and he got to know the entrepreneurs like Derek and like Conda and Jessica and Sydney Hargrove and several folks who were looking at this kind of thing, that entrepreneurship as wealth creation in the African American community as opposed to job creation. And it's a whole lot of CDFIs have not moved to wealth creation away from job creation. When we first worked with the folks in Cincinnati, they still do job creation, and you have to use the Q program or go to Cleveland to do wealth creation. So we've built this thing, and Conda and Ronnie are the ones who are going to make it real in Oakland. So why don't you just talk about who we're working with and what it's all about?
Yeah, so simultaneously with Kevin on his track of trying to figure out, why the African and not African Americans and all that he was doing, and then running into Jessica and having that conversation about friends and family. On another track, Ronnie and I, who at Impact Hub Oakland, she's running Optima Business Boot Camp, and we've been talking about, at the end of the rainbow needs to be a fund. These entrepreneurs who are going through this year-long program have really going through a rigorous program, learning a lot, having great ideas, and then there's no funding, and there's no friends and family. And we're talking about our community that does not have, they're oftentimes they're still straddled with debt themselves, these entrepreneurs. They've got their student loans, they may have some credit card debt. They're paying down their debt. They're trying to do it all. They're hustling jobs. They're driving for Uber and Lyft, and they're doing everything possible and trying to keep this business going. This great idea, and there's a lot of them that are really, they're just ready. And if they just had the money, it would be done. And so. We've been talking about having this fund at the end of the rainbow that would be really helpful, but it has to be super friendly, right? Something that does not count on what is your credit score, how much debt do you have, none of that is important, and that there's some kind of a grace around paying it back as well. It's got to have a low interest rate, because one of the things that we as the people of color and Black community, we get offered loans, but we don't get offered equity as much, as often. Like, you'll go into these other businesses and, I'll be an equity player. And so equity gives you time to play with it and hopefully make it happen without straddling you with debt and something that has to be paid back. So it's easier if you had that equity, and it's a harder play to get equity. And so we're often, the only instruments that are available are loans, and the loans are really hard to, people don't want more debt. They've already got debt, and they're trying to just get over and get into a place where their businesses can grow. So we've been looking at that, and then Kevin comes back, and we're talking, and in this incredible relationship with Self-Help, and who has just been amazing. Self-Help Credit Union, amazing, starting with Napoleon, and now has moved to the Oakland team. Annie, who you met, and Brian, who are here. What we're doing now is just trying to make it work. It's going to work. We are in the process, but we are fitting a round peg into a square hole, because we are asking for terms that are really going to work for our community. And it's something that is equity-like, something that is maybe hybrid. We're really looking for this hybrid model, and honestly, there's nothing like it. and they have all the passion to do it, and we're trying to work out the back end of how it's going to work. Because in order for it to work for our community, it really needs to be this kind of this hybrid where there's an equity part of it, at least at the beginning, that then the debt can be serviced later, but that there's some grace period so that these entrepreneurs can really get out the door. Because as you know, when you get a loan, it's due immediately, payments are due, and that is not going to work for our community. And so we're in this creative process right now, trying to figure out how do we do this, what is it, and there's a lot of ways to skin, I shouldn't say that, I love animals. There's a lot of ways to try to make it work, and so we are being creative right now and looking at all the different ways and taking this to that, the other, but we're committed to working together, we're committed to it happening. It's happened. It's just what is the best way that's going to work for self-help and the laws that exist, and that we're having to bend and work around, and what's best for our entrepreneurs.
And so another characteristic of this thing is that it's linked to an above-market CD. Okay, so if you do this, you can invest in justice at zero risk at above market. Or another way to think about it is you can put your savings at Wells Fargo for less money and do bad. They might do all the manipulation with you. Or you can put your money at self-help, make more money and do good. It's up to you. Do you want to make less money or more money? Okay? Do you want to do good or bad? Well, what if you could make more money and do good, guaranteed, and you would do these loans. And then we have a loan loss reserve. We have an informal commitment from a large institutional donor. It's what we're supposed to say at this part of the process. And but we're also raising it here. We would love to contact anybody. If you're interested, we're going to have ways to contact you. We want people to, make more money and do good. I mean, if that appeals to you, raise your hand if you'd like to make more money. Just if you'd like would you like to make more money and do good? Okay. Well, okay. Or, you can go down the street and make less money and do bad. It's up to you. But so we're trying to raise depositors. A simple thing is just make more money and do good, create justice at above market rate. And then we also, if you want to have this grow, we need more people beyond our institutional funder to do more of the loan loss reserve. And we're working to reduce the loan loss reserve, but we need that because friends and family always needs a loan loss reserve if it's a financial instrument. Friends and family, if you're a Stanford grad from Palo Alto, needs a loan loss reserve if you're going to do a loan loss reserve as an instrument. It may need more in Oakland than it does in Palo Alto, depending on the, characteristics of things, but you still need the loan loss reserve. And so there's actually no data that we can find on how friends and family works for any ethnic community in terms of success rates and stuff. So that's going to be an interesting thing because nobody's ever institutionalized the lack of having a rich uncle. So we're building, a piece of infrastructure based on the rich uncle you don't have if you're this community. But I think it'll be a great sale. The other thing we have to work on is what they call absorptive capacity. It just means we're working with lots of folks who are entrepreneurs who, we have a formal relationship with Kiva Zip for their East Bay graduates who have gone through one of their loans see if they need anything for expansion. We're working with lots of accelerators. But that's what, I think it's going to be an easy sale. We just have to work on the pipeline. And we're starting conversations to bring it to San Francisco. And these things take a long time. And we're going to work out what the loss curve is, in Oakland, to figure it all out. And we think we can pilot it. And then we'd love to get up on the Q loan program and have it on an exchange and distribute it and things.
I mean, we heard a little statistic earlier today about the gap in the wealth, the 11,000 average wealth of African-American family versus 144 for average white family, and that it would take 230 years to close that gap. 230 years if the white family wealth stayed where it is and didn't grow. 230 years at the rate that we're going right now to close that gap. So what we're looking at is how do we want justice? Do we really want a world that works for everyone? Do we want a world that really, I think that's what this conference is about. And so we're looking at being able to help close that gap a little quicker because through entrepreneurship, we believe our theory of change is that that's where wealth is going to be generated in our communities, is through entrepreneurship. And so we're looking to try to close that 230 years a little bit and to equalize the playing field a little more. So that's what this is about.
I was. Oops, can I borrow a mic? I wanted to bring up Force for Good. That was kind of announced yesterday at Conda's event at Impact Hub Oakland. And that's a fund for women, minorities, the types of people that we're talking about who have a hard time raising funds. And that, I believe, is equity. Is that right?
Actually, Force for Good, thank you. Force for Good is just getting started out the door. It's really going to be fantastic. And essentially, it's any instrument. I mean, it could be debt, it could be equity, it could be, it could be a convertible note. It depends. It's going to be directed to exactly what the entrepreneur needs. It's going to be very individualized, and the tool will be determined depending on the entrepreneur.
And then, interestingly, they're crowdfunding that.
They're using the crowdfunding law, or?
Yeah, they're currently raising money on WeFunder under Title III to raise money for this. You can't fund a fund with crowdfunding, but I think because it's an accelerator or there's some way they're able to do it. But
Yeah, okay, great.
Yeah, so a big part of the problem that we have is the good investment opportunities currently are only open to wealthy investors. Because of the, sort of the prevailing status quo, conventional wisdom is that when businesses want to raise capital, unless they're very, very large and want to go out to, do an IPO, but those businesses who are growing rapidly, when they want to raise capital, they're going to do, go out to a venture capital firm or other private investors via a securities strategy that requires that those investors be accredited. That means investors have $1 million in assets. Those are the great investment opportunities, growing business, to invest in growing businesses and get some upside when those businesses do well. And again, under the conventional system, those are only available to the wealthy. Well, that's a big part of the problem that we need to change. And the good news is that we can change it, and that's where DPOs come in. But I also want to address this question about funds, because this is something that at Cutting Edge Capital we've been doing a lot of thinking about. There's, stepping back and looking at it from the big picture point of view, there's really two ways an entrepreneur can raise capital from their own community. And by own community, again, I mean going out, to anybody in their community, regardless of their wealth, regardless of their ethnicity, but whatever their community is, they should be able to go out to that community. There's two ways to do it. One is through a direct public offering or some kind of a crowdfunding raise, and the other is through a community investment fund. Now, we've been thinking a lot about community investment funds because they can take that concept of community capital and scale it up, make it more efficient because from an investor's point of view, I need to do my due diligence only one time on a fund, and then that fund can invest in 20, 50, or 100 entrepreneurs, and and that's more efficient from an investor's point of view. A fund can also offer more potential exit strategies that an individual entrepreneur can't, and then of course a fund is inherently more diversified, which reduces risk for investors. So how do you do that? And I think we'd all recognize that there's a need there. And let me pause for a moment and mention, I think one of the big issues here also, besides the fact that the legal, the financial infrastructure favors the wealthy, the other issue that we're dealing with is even though these strategies, these community investment strategies, are available now under existing law, there's no culture of community investing. If you talk to someone about, to a typical non-accredited investor about investing in local businesses, they either don't know it's possible, or if they have heard about it, they're skeptical and they go, well, that sounds kind of woo-woo, that sounds a little fringe, I'd rather put my money in Wall Street. So we lack a culture of community investing. So we believe that community investment funds can solve both of those problems, rapidly scaling up this just transition to a locally based, more democratic economy, and creating a culture of community investment funds. So how to do it? the big problem with community investment funds, and I'm sorry if I'm going along a little too long here, but I'll try to be quick. The big problem with community investment funds is the 1940 Investment Company Act, and I won't get wonky. If anyone wants to talk about it in detail later, I'd be happy to. But the point is, it's a law that imposes very heavy burdens on any entity that takes in investment and then invests in something else. Now, there are some exemptions to it, and that's the key, because you don't want to have to comply with that law. It's just too unwieldy. It only makes sense if you're talking about a multi-billion-dollar fund. It's not appropriate for a community scale fund. So how to do it? Well, there's exemptions from the 1940 Act. One of them is for charities, and so that's why there are a lot of charitable loan funds. There's a number of them. Some of them serve specific communities. Some of them are more nationwide in scope. I worked for a number of years with RSF Social Finance, great organization. They have a $100 million charitable loan fund, and there's a lot of others that are of different types. And those are great, and I think every community needs to have a charitable loan fund that serves that community. But that itself won't really solve the problem, partly because when you're a charity, you can only issue debt. You can't issue equity because you can't own a charity. And as a result, you typically have incoming debt, outgoing debt, and then once the charitable organization deducts its spread to cover its cost of operating, by the time the investor sees an interest rate, it's usually less than the rate of inflation, which means it's not really making any money. So that's not going to move the needle significantly. But how to do it? There's got to be ways of building an investment fund that actually can provide profit to investors at a community scale. Well, one strategy is represented by a guy sitting right here, Craig Sharton, who I think you heard from earlier, a real estate fund. Real estate investment is not subject to the 1940 Act, and so you can have a locally focused real estate fund that is truly a community investment fund, open to the community, and when those properties generate profit, the community will benefit. It will build wealth organically in that community. But that doesn't allow you to invest in companies. How do you invest in companies and actually see upside when those companies do well? Well, that gets a little trickier, but it can be done. And maybe I won't go into any detail now, but come and talk to me later. It can be done. If anyone wants to set up a true community investment fund for equity in businesses, we can set it up for you.
That's great.
Love to hear about that later. I think we need a Jobs Act for the Community Investment Act, or the Investment Act of 1940, whatever. Just a couple of things.
Yeah.
To the issue of this friends and family gap and the rich uncle problem, this is a big problem, and I think we do need to think about it from a lot of directions. And one thing I've been thinking about, whether it's with crowdfunding or maybe it could also work with your CD, is what about the anchor institutions or the foundations or the community banks? Like, why couldn't they be matching funds that people, say a community, people can come up with $10, but not $25 or whatever it is. There should be these matching mechanisms to help amplify the funds that people do have. One thing that Kiva has learned very well is that skin in the game is a really good indication of success. So it does help to have that community participation, even at a little, small level. People feel more invested, literally in the company, but figuratively, they're engaged, they're part of it. It starts building, that, and it's ownership, right? And you want to build an ownership society. So I think there are ways we can think about bringing in financial partners that can match investments at a small scale.
And we've been approached by Main Street to possibly do that in Oakland. Because Kiva has pioneered it with CRAs in three or four different Community Reinvestment Acts. So it's not rocket science anymore like it was 2 or 3 years ago. So I think we have a lot of experts here. I'd love to open up to questions, critiques, comments. Tammy. question is about investor expectation on returns for crowdfunding and our CD.
In terms of crowdfunding, it's a little bit all over the map, but the nice thing about crowdfunding is the business, the entrepreneur sets the terms. So they may be offering a loan at 5% or revenue share. Revenue share has actually been very common so far because it's probably the least risky for both the business and the investor, because if the business is paying you back, it's like a loan, but instead of a fixed rate, if they have a good month, they're paying you 10%, so it's higher, they can pay back more or lower. So, but they're getting to a fixed number, so it might be 1.5 times your original investment. They'll pay you back till they meet that, or 2 times. And so far it's been 1.5 times, and your rate of return will depend upon how long it takes. And I think, I don't know, we'll see with equity. I think that equity investors are maybe hoping for like that big kind of payoff. I don't know. I think it varies. This question comes up all the time about investor expectations, and it's really all over the map. If you're a social investor, you're more comfortable with something less. If you're sort of a, old style investor, you're probably hoping for more. And I'll let you talk to the CD.
On investor attitude, we don't know on ours. We've come to the terms of it. I mean, for myself, I'm looking to, when I go back to Mississippi for Thanksgiving, and the trade-off has been in the last couple of years that I can't talk about fair trade and they take down the flag. But I think I could talk about this investment, that I'm making more money investing zero risk on justice, whereas you're making less money than I am investing in bad things. I think they'll let me talk about that, back in Tupelo, Mississippi, in a way they don't want to hear about either climate change or fair trade. And the only thing I get out of them is that the flag comes down when they know we're coming to town. So I'm encouraged by Thanksgiving meetings with, the people the populace of Mississippi, Thank you, and I should mention, Investibule is brand new. It's investibule.locavesting.co, and we're starting with crowdfunding, broadly speaking, including prepay, rewards, loans, and equity. But we would love to have, the wonderful Runway Project CD and, all of these other funding options that are evolving. And what's so exciting right now is there's so much innovation, and I feel like we're really, at the beginning. And this time next year, I think there's going to be a flourishing of all sorts of different models. So, looking forward to that.
And let me also mention that I'm privileged to be part of a team that's building a community capital marketplace that will be called SVX.us. It's in partnership with a Canadian organization that has been running a Canadian impact investing platform called SVX.ca. They've been up and running for a number of years. You can go and check it out. That's currently being revamped. We have a new technology provider, and that is the U.S. group, anchored by Cutting Edge Capital, is going to be rolling that out, hopefully in just a very short time. It's in the latter stages of development, but this will be a community capital marketplace. As I said, it will include direct public offerings. It will include private placements via a broker-dealer partner. It will eventually include Title III raises, Reg A raises. It will be a whole ecosystem of community
Reggae
capital.
raises?
I know, reggae.
And by that,
Regulation A.
I didn't exactly mean the music. Thank you.
Everyone thinks of Bob Marley.
Regulation A.
Everything's
yes,
going to
thank
be
you.
all right.
Thank you for the clarification.
Are there other questions or comments? Yeah. Oh, Amy, go ahead.
Public service announcement, but I'm moderating a panel on tomorrow afternoon, about crowdfunding for impact, because as part of this, new evolving, industry, I think it started out with people doing pretty much the same thing, like in real estate, it's all about yield and how to make accredited investors even richer. Well, but we're starting to see new platforms that are really focused on underserved entrepreneurs, on social ventures, and neighborly, on reviving the muni bond market. So the real John Katovich will be on my panel, Neighborly Republic, which is a brand new site, and possibly someone else I'm forgetting, but if you want to hear more about it.
We talked earlier how this is kind of like where SOCAP was in 2008, but you can see that it's going to accelerate so much faster. There's all these interlocking platforms that need to be interoperable and not proprietary in any kind of way. But I think everybody realizes that that's what you need, is interoperability between all this innovation, and then figure out how to do it and figure out what they're doing in Fresno that is similar to what's in Twin Cities. All this local innovation needs to be the discovery phase. So that's, do you folks think there needs to be a really big multi-day local economy, how to localize your economy conference? Do you think there needs to be? Yeah. Yeah, I think there is, and there's so many people who've spoken here, and I think the way we want to actually do it is figure it out from a vendor-centric kind of thing, because we've got to figure out who your customers are and who your customers are and who our customers are and where's the overlap, so we can build a broad marketplace between us and Neighborly and all these things that we haven't seen. And it's we're going to have to figure out how to cooperate, and not get into turf battles to make it happen, but I think there's something big to be happening. So any other questions? I think we're ready to close. Yes?
Thank you. That's a great question. So we have, at Impact Hub Oakland, we also have we're one of the only hubs, I think, that has a youth hub. We have a youth impact hub that's down the street, and they have their own space and a cohort of young people who are, right now, we have a cohort of, I think, like maybe 13 businesses and teams who are in this cohort, and every year we do a cohort. This will be our third cohort coming up. And so it's really, we have so many people, so many young people who are applying to get in, and we choose the top teams, and it's really going well. So one of the things that we're doing, even with our CD, is we're talking to, I just had a meeting with my team who runs the Youth Impact Hub to find out who do we feel is ready for something like this. And we have definitely one company, as well as what we're doing is there's something called the OE100, and that's Oakland Entrepreneurs, the 100 Entrepreneurs of Youth. And so we've done a collaboration between Impact Youth Hub and and it's called Business USA, which is another youth organization. So together, we've come together and created this OE 100, which is trying to get 100 entrepreneurs, youth entrepreneurs of color, supported on this platform. And the city of Oakland's behind it. We've gotten money behind it. So we are working really hard in our community, because it's really clear to us when we even started Impact Hub Oakland that if we weren't dealing with the youth, we weren't doing our business, right? We weren't really taking care of business the way it needs to be. And so the youth in Oakland are stepping up to the plate, you know, and there's so many challenges. And yet, you know, those who don't get into Youth Impact Hub are seeing the models of those who are, and really trying to step up the game, even with all the challenges and barriers that exist. And so we're working really hard to do that and to bring our youth into the mix. And we definitely, once all this gets on board, we'll have youth involved as well, youth businesses. Thank you for the question.
So, okay, turn on, quick, yeah.
Thanks very much for the ideas. But I've been doing finance 25 years, and I've made investors and entrepreneurs filthy rich on both sides of the house, right? And based on my experience, I tend to agree that the problem with crowdfunding, and also the benefit at the same time, is that, yeah, it gives access to everyone, but does the entrepreneur want to deal with $1,000, $20 investors? Really? Will they have time to deal with those investors?
And we don't have time to answer that, but you can talk to Amy afterwards, because they're telling us that we're done. So
That's a
they're
great
still here.
question, though, Hernan.
Yeah.
Great question.
Thank you. I want to
Thank
thank
you,
all
everyone.
my fellow
Thank you.
Thank you. So get in touch with us if you're interested in investing in this product, okay? We need you.